Welcome back, everyone. Today, we are diving into day 5 of the Crypto Trader curriculum. We've been building a pretty rock-solid foundation up to this point, but this specific chapter, it focuses entirely on market structure. In this explainer, we're going to look at exactly how the curriculum decodes what I like to call the hidden language of the markets. We're taking what often just looks like unpredictable random noise and turning it into a readable story. Let's get right to it.
So ask yourself an honest question right now. When you look at a chart, do you see chaos or do you see structure? When most people pull up a crypto chart for the first time, it's just this chaotic mess of zigzags, right? It just looks like random lines spiking up and crashing down without any real rhyme or reason. But don't worry, because today's explainer is going to solve that exact problem. We're going to break down the market's underlying anatomy so you can actually start seeing these charts in a completely different way.
Let's zoom in a bit for section 1, the 4 building blocks. We have to understand these 4 foundational pivot points at a microscopic level before we can really read a chart.
Okay, let's dive into this with the very first letter of our market structure alphabet, the higher high. So a higher high is simply a peak in price that is, well, higher than the previous peak. Think of it kind of like climbing a staircase. Your foot lands on a step, and the very next step you take is physically higher than the last one. In the market, this basically represents buyers pushing the price up to a brand new ceiling that totally eclipses the old one. It is the ultimate sign of aggressive upward buying pressure.
But as we know, a market can't just go up in a straight line forever, which brings us to our second building block, the higher low. Now, a higher low is a trough, or a dip in price, that is higher than the previous trough. Let's just pause and really think about the psychology here for a second. Why exactly does a higher low happen? Well, it happens because buyers are just so eager to get into the asset that they step into the market earlier than they did before. They aren't waiting around for the price to drop all the way back down to that previous bottom. Instead, they buy the dip early, which creates a new elevated floor.
Now, we need to shift our focus over to the bearish building blocks, starting with the lower high. A lower high is a peak in price that's lower than the previous peak. So if the higher high is that staircase going up, the lower high is kind of like hitting your head on a descending ceiling. And this is an absolutely critical early warning sign. When you spot a lower high, it's basically screaming at you that buying pressure is weakening. The bulls, they tried to push the price back up to those past glories, but they just didn't have the strength to pull it off.
And that brings us to the final piece of our rapid-fire sequence of basic components, the lower low. A lower low is a trough in price that is, you guessed it, lower than the previous trough. Essentially, the floor has completely fallen out. The sellers have totally overwhelmed the buyers here, forcing the asset's price to just drop right beneath that previous safety net.
And this brilliantly illustrates how the eternal battle of the market really just boils down to 2 sides. On one side, we have bullish structure. That's characterized by those higher highs and higher lows we talked about. This is the upward momentum, the sheer optimism, the buyers being in absolute total control. Then, on the exact opposite side, we have bearish structure, defined by lower highs and lower lows. That's the downward slide, the pessimism, the sellers taking the wheel. Literally everything you see on a chart is ultimately just a giant tug-of-war between these 2 structures.
Moving on to section 2, identifying market trends. Now we're going to zoom out a bit from those individual pivot points and see what actually happens when these little building blocks form much larger macro market behaviors.
So when you start stringing these highs and lows together in a persistent repeating direction, what you create is a trend. A trend is really just directional market movement over a period of time. It's almost like the market is finally making a decisive choice about where it wants to go. It's no longer just a single isolated peak or valley, it becomes this unified march in one clear direction.
So how exactly do we read this? Well, it's actually incredibly straightforward once you know the steps. Step 1, if you identify consecutive higher highs and higher lows, boom, you're looking at an uptrend. The market is clearly bullish. Step 2, if you identify consecutive lower highs and lower lows, you are looking at a downtrend. The market is bearish. And honestly, that's pretty much it. You don't need any sort of magic or complex math to read a trend. You just need to patiently observe the sequence of our 4 building blocks.
All right, let's look at section 3, ranges and breakouts. This is where we transition into what happens when the market suddenly stops trending and starts moving sideways in a bit of a holding pattern.
Because, sometimes the market just has to take a breather. Now, unlike trends, which obviously have those directional highs and lows, a range is an entirely different beast. A range is sideways movement. It's characterized by horizontal highs and lows. This happens when the buyers and the sellers reach a temporary stalemate.
The buyers push the price up to a certain ceiling, but they just can't get it any further, and the sellers push it down to a certain floor, but no further. So the market ends up just bouncing between these two invisible walls, without any clear higher or lower progression.
But, as we all know, a stalemate never lasts forever in crypto. Eventually, the pressure builds, the tension absolutely mounts, and then, boom, we get the breakout. This is the exact split-second moment where that range violently shatters.
When a breakout actually happens, it is incredibly explosive. First off, those horizontal range boundaries we were just talking about, they completely shatter. Second, the momentum instantly shifts from being sideways and horizontal to aggressively directional. And third, a brand new trend is catalyzed right then and there. This exact transition, moving from that quiet, boring stalemate of a range to the sudden, violent explosion of a breakout, this is the primary catalyst that professional traders are always waiting for. Honestly, it's where the real opportunity lives. Okay, let's wrap this up with Section 4, the Historical Charting Challenge. It's time to pivot from passive learning to some active application, because the curriculum actually has a practical homework exercise assigned for Day 5.
10. That's the magic number. I am heavily stressing the number 10 here because it's the final, totally non-negotiable directive from today's text. You literally must go out and mark market structure on 10 historical charts. Not 1, not 3, 10 of them.
Let's just read it directly from the source. Practical. Market structure on 10 historical charts. So the crucial point is this: you simply cannot survive Day 6 without completely mastering Day 5. This is not just some random busy work. It's absolutely vital repetition. You need to train your eyes to instantly recognize higher highs, higher lows, lower highs, and lower lows without even having to think about it. You have to practice outlining those ranges and pinpointing the exact breakouts on real, historical data until it just becomes second nature to you.
Which kind of leaves us with this final, provocative thought. The curriculum stresses that human psychology rarely ever changes, which means these chart patterns, they repeat over and over again. So, if history really does repeat itself in those 10 historical charts you're about to go study, are you ready to predict the next breakout? I think it's time to pull up those charts, find the underlying structure hidden within the chaos, and get to work. Thank you so much for joining me for this explainer, and I'll see you next time.